guest, Harsha Upadhyay of Kotak Mutual Fund, who is our market master for the day, joins in now. Harsha, good morning. Very interesting trends in the IT space. You have TCS on one hand that underperformed, Infosys on the other hand that delivers in this quarter but guides for a weak FY17, and now you have HCL Tech. How are you positioned in this space?
Good morning, Sonia. Clearly, we believe the issues that are there in the IT sector are unlikely to go away in the immediate short term. While there could be stock-specific results which are in line or slightly better than expectations, but overall, the sector, in our view, continues to remain under a lot of pressure. There is pressure on overall growth as well as pricing. While many companies are pointing that to cyclical downturn, we believe that there are structural issues that need to be addressed. And also at this point of time when overall growth is so sluggish, most of the IT companies in Indian context are also sitting with large piles of cash, which is also not really helping overall return ratios for investors. Unless they think of using this large cash pile into something more productive, either in terms of acquisitions or in terms of sharing it back with the shareholders, it will be very difficult for them to sustain higher stock price levels.
Okay. How would you look at the financials? You know, we saw this huge rally coming in ICICI just this week because of the settlement of one watch list loan. But, you know, that's not spread as a general feeling that the banks are getting de-stressed. What's your take on financials, especially the corporate-facing financials?
You're right, Lata. As you rightly mentioned, the cleanup is going to be very gradual, unlikely that anything substantial will happen over a short period of time. Although there has been some positive move towards cleaning up some of the debt-laden corporate balance sheets, and hence any bank which has some exposure to such corporates will find it better in terms of overall scenario. But to say that everything on the NPA side is resolved and we can look forward to much better growth and numbers on that side, I don't think that's a reality as yet. We believe that this quarter maybe some of the banks will be able to cushion some of the provisions that they need to make through treasury profits that they may have made. Treasury yields have fallen substantially during the quarter, maybe by 60-65 basis points. So to that extent, yes, there will be some cushion during this quarter. But overall, I would say that it will take some more time before they really clean up their balance sheets.
Okay, I just wanted to add my two-bit over here. I had a very detailed Indianomics chat with the heads of two credit rating agencies and Saurabh Mukherjee of Ambit. And the unanimous view is that banks are not getting de-stressed, that promoters who are selling off their silver, like SR Oil, are not left with enough money to put into their bad assets. So the bad loans continue to remain. It's only the good assets, which anyway the banks don't want to lose, that are going to, you know, new owners. And it was a very dim picture, almost gloomy picture, that the stress loans of whatever 8 or 9 lakh crore, it's just going to remain that way. It's only if there is growth. And actually, from Credit Suisse, another point on the lines of what Harsha is making, yes, they've got some bond gains, because mark-to-market gains, but that is getting eaten away by their increased pension liabilities. And pension liabilities get worse when yields fall, because you know you have to pay out of your pocket to meet the same old defined benefits. It wasn't looking very good yesterday after the Indianomics discussion.
I guess the market is wise enough, because that's perhaps the reason why the Bank Nifty itself is down about 0.5%. But Harsha, I was just going through you know, your top holdings in your select focus fund, and Reliance Industries is one such. Why do you think Reliance is not performing? I mean, despite doing good numbers quarter after quarter, the stock just refuses to outperform the market. What's your view?
Sonia, as you know, we can't make stock-specific comments, so I would avoid that. But I think whatever positions we have in our fund is more from a medium to long-term perspective. We really don't look at it on a daily or a weekly basis. To that extent, our positioning continues to remain in stocks where earnings growth is much higher than the market. And we believe as long as we don't overpay for some of these growth areas, we will be fine. And as far as petrochemicals and refining are concerned, I think both segments are seeing reasonable uptick, and we believe that's likely to continue going forward as well. And overall, we remain in areas where growth is visible and also is available at reasonable valuations.
Okay. So, Harsha, what are you looking at in terms of, the earnings picture itself from what you have seen of the second quarter? Is this likely to surprise slightly on the upside or indeed on the downside?
I think if you look at the headline numbers, whether Sensex or Nifty, I think that's not going to give a clear picture, because many of the sectors where there is earnings growth is not really well represented in some of these indices. The broader market outlook is much better than what's the outlook for, say, Sensex or Nifty. Having said that, I think even the headline numbers will see some small momentum in terms of overall earnings growth during this quarter compared to previous quarter. And also, if you set aside some of the corporate-facing banks which generally have been dragging overall earnings, then I think the Nifty growth also will look much more reasonable. For example, previous quarter, that is June quarter, if you removed 4 companies which are essentially 4 corporate-facing banks, 2 PSUs and 2 private sector companies from Nifty, the rest of the 46 companies have actually grown their earnings in the mid-teens on a year-on-year basis. I think that is the trend that one needs to look at. And our belief is that is getting marginally better even during this quarter. And also, as we proceed into December and March, the drag from corporate-facing banks will start to reduce, and overall headline numbers will also start to look much better.
Okay. One segment that you have a high amount of presence in is the cement space, and that sector has given great returns up until now. What are you expecting to see this quarter? We've already got some companies like Ultratech Cement post their numbers, but what is your own expectation?
Clearly, our focus has been domestic-oriented businesses where there is higher operating leverage, and that's the pocket which is likely to give better earnings growth compared to overall market and also as compared to global-facing corporates. And our business, our focus has been into companies where there is such high operating leverage. Cement happens to be one of those sectors. Clearly, we have seen prices holding up, volume growth coming back into the sector, and there is reasonable degree of pricing power in the industry, and which we believe will definitely help profitability to remain very high. And we continue to remain very positive on the sector.
Okay. So here on, Harsha, sectorally, what would be the leaders for the next 12 months?
If you look at our portfolio positioning, we are overweight on auto, cement, oil and gas, and also retail private sector banks and retail NBFCs, which are facing consumers in general. So I think these are the areas where we believe if you are picking stocks at reasonable valuations, the earnings growth is definitely much higher than the market, and hence you will be able to make more money than the market.
Okay, Harsha, we'll have to leave it at that. Thank you for joining us and giving us your view. So that is the word coming in on, from Harsha Upadhyay.